Welcome, and thank you for joining us on Zoom. I'm Gloria Palmer, the Executive Director of Green Mountain Academy for Lifelong Learning. Peter Radford is the publisher of the Radford Free Press, a blog on economics covering contemporary issues and the state of economic theory. More broadly, he is also a writer and consultant on economics and business theory. He is a co-founder and serves on the executive committee of the World Economics Association. Peter has been a frequent presenter for GMALL and also a moderator of the popular discussion group, The Weekly Roundtable. He has participated in our great GMALL debate each summer pre-COVID, and he is also president of GMALL's board of directors, and we're very happy to have him here with us tonight. So thank you, Peter.
All right, thank you very much. Let me get that. Can everyone see the screen? There you go.
Yes.
All right, there we go. We can kick off then. All right. So first of all, I'm going to apologize. When I started putting this presentation together, I realized what a fool's errand it was. This is a subject that is slippery, convoluted, and highly speculative. So I am bound to have missed something out of here. One of you will undoubtedly notice. So when we get to the questions, hopefully you can throw it at me and wonder why I didn't put it in. I'm going to follow this agenda because I want to reset and put the post-pandemic in the context of where we are, or more to the point where we were before the pandemic broke out. So I'm going to look at that. I'm going to then look at issues and trends. I want to talk about the recovery. People are going on about this V-shaped recovery, or is it a K-shaped recovery? And it's kind of difficult to even understand what it is. It's important to understand a recovery to what, and then we'll get to the final slide. There's about 25, 30 slides here. The only one that I'm going to actually have post-pandemic written on it, because it's in the emerging trends and issues that we'll really get to the issues. So let's set the stage. Let's remember where we were before this thing started. Going back, if you can possibly remember that back then, a lot's happened. Try to imagine where we were at this time last year. We were having conversations, election coming up, Donald Trump is going to be with a terrific economy behind him. This looks a very difficult election. There were some of us, however, sitting there saying, slow down, the economy's reaching a peak. The unemployment's at a 50-year low. There's not a lot more slack in the economy to be taken up to continue growth, at least to continue growth at a fast pace. Capacity utilization, just to pick one statistic, was it's kind of a 15-year high. The Fed had already tightened monetary policy in 2018 in anticipation of the economy hitting its cyclical peak. But then, of course, about this time last year, it had already eased again because they were concerned that the economy may be slipping down. Retail sales had flattened out. If you look at a line of retail sales, they're kind of straight across the page. Industrial production was stalled. The federal budget was increasing because of the tax cut, 2017 tax cut. And then again, we were in this on-again, off-again trade war with China and the EU. So the economy, we're returning, when we talk about recovery, we've got to be aware of what we're returning to. It wasn't an economy that was in bad shape, but it was an economy where the risks were accumulating on the downside, not on the upside. So the risk was going down, not up. Let me just briefly look at this. This is the unemployment rate. You can see with the big spike in 2010, with the Great Recession, down. And we were, that's a 50-year low. Industrial production, I mentioned, straight across the page. This is not an economy that is bundling along at a great pace. It's an economy that's reached a stage of maturity. Not bad, but not great either. Here's the Fed funds rate. I mentioned they tightened. That's why it goes up towards January 2019. Then you can see that the Federal Reserve Board had started to get concerns about the direction and the continuing strength of that economy. For those of you who can remember, Donald Trump was complaining about the Fed tightening, and then of course he was so happy about it easing up again. But the Fed was clearly concerned about the 2020 and 2021 outlook. Take the pandemic off the page. This is, for those of you, I've inflicted this on many of you, so I apologize for inflicting on you again. This is my very favorite chart, however, so I can't leave it out of any presentation I do. The gray line here is the potential GDP. The magenta line is the actual GDP. To the extent that that magenta line is below the gray line, we as an economy are leaving money on the table. We're not getting as much wealth generated as we could do. And you can see the big sort of drop there around the Great Recession. But the key thing is to look at the top right-hand corner. Those two lines have now met. And it was because they met that you started to see conversation about, well, there's not much more we can squeeze out of this thing. We're now going to be bundling along roughly at that 1.5 to 2% number, not 3%, not 2.5%, but maybe 1.5%. And some people this time last year were even talking about potential downturn in 2020 or 2021. So we had squeezed everything out of the economy that was possible. So let's just summarize that quickly. We were at a peak, little capacity for rapid growth. Trade wars were definitely adding uncertainty. And then this was strange thing going on in China, in Wuhan. None of us know where that was. Turns out it's one of the great centers of car manufacturing, but who knew at the time? And it was concerning investors. And then, so the forecast was a slower 2020, and some were even worried about a downturn. Then this happened. Here we are in July. Look at the extraordinary, I've got a series of charts here that just are kind of mind-boggling because of the staggering shifts. There's nothing going on. Unemployment rate is really static, 3.5%, 50-year low, and then boom. This is the initial claims for unemployment insurance. I remember giving talks when 200,000 to 250,000 was something we would talk about as an interesting event. Is it going up to 300 or 400? If so, we're probably headed to recession. The week of March the 28th, we had just under 7 million people. Nobody had ever seen anything like this before, which is why talking about the post-pandemic gets a little difficult. Nobody's been here before. This is the labor market. Participation rates and employment ratios, things we kind of look at to see whether people are encouraged and joining the workforce. And you can see the blue line, it's steadily improved since the Great Recession, very slowly, I might add. And then the bottom just dropped out this year. Retail sales, this is one of the most boring charts because every month there's a little bump up, bump down, and it shows an economy that's not booming, but it's producing decent enough sales to keep consumption going. Don't forget, the United States economy is a consumption economy. 65–70% of GDP in this country comes from personal consumption. So we need people with money and spending it. You look at the great collapse and then the odd recovery. Trying to make sense of what happens next is a fool's errand, I think. But that's what we're doing tonight. There you go. The Fed funds rate. Remember, I cut this off in a few minutes ago, and now you can see the Fed reaction in April and May. Interest rates back to zero. The Federal Reserve Board has done some extraordinary things this year that even more dramatic than the things they got criticized for in the Great Recession. And this is a chart of quarterly GDP, again, trying to give you some context. That line on the right-hand side is the second quarter. The third quarter numbers are obviously going to be much better than that. But I think we have to, two things to say about this. One is we lost about $2 trillion out of GDP. So when you start talking about stimulus packages, remember 2 trillion. It's a very, very significant number. And the other thing we've got to remember is that this is so dramatic, so off. Nobody's seen this before, that it puts the Great Recession of 2007 and 8 and in context. If you look across the chart towards the left, those little bars coming down, that's the Great Recession, right? And look at this thing on the right. It's absurdly large. And we are going to see, I think, an absurdly large number going up. as we kind of come out of this thing, and then it will start settling down to what, which is what we're going to explore tonight, I think. So this is a summary and gives you a taste of the discussion that we're now going to get into. The Fed has done some unbelievably unusual things. This is just the one I put on this top chart here. The corporate debt backstop is, if anybody had asked me 10 years ago that they would be doing this, I'd have thought you were from the moon. The Federal Reserve right now is on its shoulders carrying the economy around, teetering about. Interest rates are an astonishingly low rate yet again. We've flirted with negative interest rates. I don't know if any of you follow any of this, but in the UK, the British Treasury has actually started asking the banks whether they will accept negative interest rates on government bonds. This is a really Alice in the Wonderland world we're venturing into. Likewise, public debt through the roof. The debt to GDP ratio is over 100%. Now, I don't know if any of you remember, there was a book that gained a lot of traction during the Great Recession called This Time is Different. And it was by Rogoff and Reinhardt. And they said that any time a country gets over 75% of debt to GDP, you've got to start worrying about that country. It's teetering on the brink of things. And if it gets over 100%, definitely you're in deep, deep trouble. And here we are, over 100%. The financial markets have taken it well in their stride. It's an astonishing turn of events. We are learning so much, so fast about what all of these old rules of thumb actually mean. We're learning a lot of them don't mean much. Clearly, the governments have put everything on a life support. This recession was created. It's not a recession that came from something going on in the economy. This was a created recession. The most recent good analogy is back in the Reagan era, when Volcker created a recession to squeeze out inflation. So a lot of people who are looking at and talking about a V-shaped recession are probably going back to that experience and saying, oh, well, we can just replicate that, because for those of you remember it, very sharp increase in unemployment, big drop in activity, followed by a very sharp increase. And that's where the whole V concept comes from, really. To go down the list, workforce just absolutely hammered. Hours worked in this country dropped by 25%. As I said, the participation rate was below 70%. The participation rate for 16 to 54-year-olds, sorry, 24 to 54-year-olds, actually dropped below 70% for the first time in 50 years, which goes to show the dislocation that took place. Then we've got these interesting things. I just put them in there because these start to hint at things that are going to have to be talked about post-pandemic. Supply chains. Goodness. Who in this, I was going to say in this room, of you all watching, let me rephrase that, how many of us really knew that half the pharmaceuticals in this country are either manufactured in China or in India? More to the point, what about all the medical supplies? We have learned that this concept of just-in-time inventory is a very dangerous concept. It's based upon theories of efficiency and so forth, but it also presumes that these supply chains are going to be robust. So we'll get to talk about that. The stock market. If anybody asks me about the stock market, I'm just going to feign ignorance. It clearly has nothing to do with the economy right now. There are some people I get into discussions about saying, oh, no, they're discounting maybe a Democratic sweep and there's going to be a big stimulus. Some people say it's discounting all these earnings that are going to come popping up when we get the V-shaped recession. Yeah, sure. It's also got something to do with the fact that the tech stocks have boomed throughout this pandemic. And a lot of the earnings reflected in the stock market come from abroad. Then there's the poor retail sector. I mean, to call it an upheaval is, I think, being polite. We're at a game-changing event. That was going on, but the pandemic has accelerated it. And then I just threw in for grins and giggles, the exodus from cities. People are moving, and that's going to have all sorts of effects. For one, it's going to change the tax base of a lot of our big cities. And the second, it's going to put a lot of pressure on the areas to which they are moving. We are going through it here. That's something we're going to have to deal with post-pandemic. So what happens next? I'm now going to throw 3 or 4 major topics of conversation. They're all kind of interconnected. It's difficult to tease them out and look at them one-on-one, so you'll forgive me if I mention one thing here and then I mention it again. Trade. Let's come back to the supply chain weakness. Clearly, this is going to have to get dealt with post-pandemic. Corporate America went heavily, because of the improvements in technology and the logistics that went with that, suddenly decided back in the 80s and end of the 80s and well into the 90s that they could build these dramatic 1,000-mile long supply chains, pull together all of their various products, have them produced in a low-cost labor market, sell them in a high-value market. The Apple iPhone is the one I've always used to describe this. 40% of it comes from Germany. That's shipped to China. About another 20% comes from Korea. A bit of it comes from the United States. That's all shipped to China. Then it's manufactured, assembled in China, and shipped here. That's a long, convoluted chain. And we've learned that it's not a very strong one. There are too many potential breaks in it. So now the conversation is, how do we diversify? Do we put manufacturing, some of it in Germany? Do we put some of it in Vietnam, Thailand, wherever? And then the consultants are already throwing around a word. Consultants love throwing around words. And the word resilience is now popping up. You listen to a McKinsey consultant and they love resilience now. They were previously selling something else. Now they're selling resilience. What does that mean? Does it mean that we've got multiple production centers? Does it mean even we bring production back to the United States? Clearly, post-pandemic, the economy is going to look very different in terms of supply chains. How? I will have to shrug. That conversation is ongoing. But the corporate focus on globalization. Globalization is a word that's been kicked around all over the place for a decade, 2 decades. Clearly, the globalization that exists post-pandemic will be a different globalization. We will be thinking of it in different ways. The third line here, trade regionalization. I think that's going to be a trend that we will see post-pandemic. You're going to see, rather than trade viewed as a worldwide phenomenon, there's going to be trade within regions. It's already taking place in Asia, largely because of China, but I put in 2 events here. The 2011 tsunami in Japan taught Japan that they have to have a different view of these supply chains. They were ahead of us in understanding that. And they built relationships within the region rather than worldwide. China is doing the same kind of thing. And I think you're going to see trade blocks, trade get regionalized rather than on a worldwide basis. So that's another post-pandemic change that I think we will see. From the United States point of view, a lot depends on the attitude the United States has towards the World Trade Organization. And I must admit, the American attitude towards the World Trade Organization is a little baffling, because that's the body that was set up to resolve a lot of the things that the American current administration is complaining about. But it seems as though every time there's a WTO decision that doesn't please them, the World Trade Organization is a bad thing. The United States is yet to figure out, I think, how it's going to play in this regionalized world. And its attitude towards the World Trade Organization will be a signal of how we're going to go ahead. Right now, who knows? I put healthcare in here because of what I mentioned earlier with pharmaceuticals, products, and services. The healthcare systems around the world have become interlinked in terms of their servicing and acquisition of products and the inputs, if you like, to the trade care systems. I think there's going to be there's going to be a retreat, and healthcare systems will become more domestic. We've just gone through this awful event, and I think post-pandemic there's going to be a big push to isolate healthcare systems, to make them more domestic rather than depend on these worldwide supply chains. Protectionism, I think we're going to see plenty more of that. I think the answers to the issues, the points I've raised above, will play into it. Populism was rising. Protectionism is the kind of the bad solution, if you like, to globalization from my point of view. We've got to figure out post-pandemic how world trade continues to exist, but on a more, reasonable and organized basis. And some of the things I've just talked about, changing in supply chains and regionalization, will shift into that. Then I put in here a shift to emphasis on services. And this is a theme I'm going to hammer away at. Work from home has changed everything. And I don't think people understand exactly how much it's changed. Look at us now, having this conversation right now. What's happened is it's actually in terms of trade, it has intensified trade in digital services. People are now sitting in their homes, still interacting, and digital products and services are moving hither and yon in ways that are likely to require government regulation and intervention. You're going to see the different regional trade blocs try to deal with or come to terms with, how do we deal with digital services and products? This ties in not just from work at home. I put it here because it's prompted by work at home on such a massive scale, but it's also going to come up again when we start talking about how do we deal with technology and the technology companies. And we've already seen, some of you probably noticed, that the DOJ, the Department of Justice, is actually launching an antitrust suit against Google. It may not be for the right reasons, but I think it's the first sign that the United States is joining the EU and some other countries in, we've got a problem. We're still dealing in a lot of ways in our thought about trade in an industrial manufacturing goods sense. We've got to come to terms with the movement of information and digital services and products. And this work from home has really just thrown it in everyone's face. So I look to that to be a major issue in the post-pandemic economy. Now, the interesting thing about that is it then exposes certain sectors of the economy to the pressures of trade that previously we've only thought of in terms of manufacturing. Globalization got such a bad name because it puts enormous pressure on the blue-collar working manufacturing jobs in this country. It depressed wages and so forth. We are going to start to see the same kind of, potentially could see, I should say, start to see the same kinds of pressures in education, healthcare, accounting, finance. All these very typical white-collar jobs are now going to be exposed to those exact same pressures. And you jump back up the line, how governments respond to the regulation of this trade in digital products is going to be interesting to watch post-pandemic, because they let the blue-collar jobs get hammered in the Western world. It's going to be interesting to see if they allow the same thing in these white-collar jobs. So white-collar jobs, will they be a victim of the pandemic? I just put that out there. I think in the post-pandemic economy, not only will trade generally change, not only we have to pay attention to supply chains, but there's going to be a great deal of focus on the regulation of and movement of digital services, and that is at the very beginnings of being discussed. Let me move to the next big topic, employment. The labor market is being changed, I mean, in every which way. I put at the top, work from home. We're rewriting employment. There are company after company after company is announcing that either that we're postponing bringing the workforce back until sometime in 2021. It's this but in some cases they are making the decision they're never going to bring the workforce back, and that has a huge cascading knock-on effect that is worth dwelling on at some length. The little chart I put on the side here comes from Stanford. It was done in the last month or so. Survey of workers who are currently working from home and asking them how do you want to go forward? Do you want to go back 5 days per week? That's the bottom bar there. 25% said, yes, I want to go back 5 days a week. Then as you work up 3 to 4 days a week, 1 to 2 days per week, but look at the top two. There's 40% plus saying either I never want to go back to the office or I only want to go in very, very rarely. Corporations are going to have to live with that, adapt to it, and work with it. And that has enormous ramifications for the commercial real estate industry, but also all sorts of things. Janitors, people who work in these buildings, those jobs are going to start being under pressure. This work from home phenomenon is going to stick around. I mean, I was skeptical early on, but now that you start seeing how people have adapted, how the technology is improving even in just a few months, and how corporate attitudes have changed towards it, I think working from home is absolutely something we can put a pin in and say that's part of the post-pandemic economy. The second point on the left, death of distance. I don't know how many of you remember. This is a plug for myself, by the way. The Death of Distance was a book written by Frances Cairncross in 1993. She was I believe, a writer for the editor of The Economist. I can't remember exactly. She wrote that book in 1993, and I cursed her because in 1989 and into the spring of 1990, I had written a strategic white paper for the bank I worked at saying that there's this thing called the internet. And as that grows, a bank, which is an institution that thrives on information, could be decentralized. We could send people home. We could actually lower our costs by having people working at home. I didn't get anywhere, obviously. And Frances Cairncross came out with this book, wonderful book called The Death of Distance, talking about exactly that. And here we are now living it. It's only taken us 27 years to get there, but we are there. And I think it's something that's going to be with us post-pandemic. That then means we need the infrastructure and the education built around the social, not just academic, but the social skills to make this new world work. And the infrastructure, I don't have to remind any of you sitting, I was teasing Gloria that if I suddenly disappear, it's because our rickety internet connection may disappear because, gasp, I'm actually using it. For this presentation, the domestic American internet infrastructure has been shown to be very, very on the edge, put it politely. And this is not just a rural issue. People are reporting in places like Connecticut and New Jersey and other dense populations that their internet connections are not up to the snuff either. If all of those people are sitting in their suburban homes trying to log on and do a long day's worth online, we need an infrastructure that allows that. So infrastructure is a thing, put a pin in it. Post-pandemic, we're going to have to deal with that. The fourth point here, structural changes. The current estimate I'm hearing, about 30% of the jobs that have been lost so far are not coming back because they're not just cyclical. They're not just people losing their job because we're in the restaurant business or something and you'll all get rehired when the restaurant opens. There's also a lot of structural change going on. Companies are taking advantage of this pandemic to make changes that are not short-term, they're long-term. And we're starting to see those kinds of layoffs creep up. And I imagine that over the next 3 to 6 months, we're going to see a lot more of that. The layoffs that we had early on were in retail, in restaurants, hotels, airlines, and so forth. The obvious personal touch kinds of things that you just can't do in a pandemic. But now, in the shadow of all of that, a lot of companies are beginning to take a look at their workforce and saying, I need fewer, and especially if we're doing this work from home thing, and if we need fewer office, we need less office space. So almost a third, I'm hearing about a third of these jobs are permanently lost, not just cyclically lost, which means that all of those people arguing for this V-shaped recovery have to fill those jobs somehow. Just as the bottom point here, I think is worth just mentioning because it's a scorecard type thing. We've regained less than half of the jobs that were lost so far, and more losses are on the way. So this is post-pandemic, work from home, the death of distance are two things we're going to be talking about a lot. But what about inequality? If there's one thing this pandemic brought home, it's the egregious inequality that exists in our workforce, in generally in the economy, but the workforce that was shown up. Essential workers, it turns out, are by and large the lowest paid workers. Which is a complete inversion of the way you would expect it. If you're essential, you should be highly paid, but apparently not in our economy. We could get rid of the CEO making a couple of million of $10 million a year, but we got to make sure the door's open, the heat's on, the place is swept and cleaned, and so forth. So our essential workers have suffered the heaviest job losses, and they're the ones that have gotten the least ability to live through a shock. So I think that there's increasing sensitivity to this subject. I think you're going to see that bottom level of wages start to rise. People are going to want, these workers have just lived through an awful event. They're not going to want to live through this again. And I think you're going to see pressure at the bottom of the wage scale. So wages will rise abnormally fast, I believe, post-pandemic. Now, it's controversial, and it depends a lot on the election, but I think that's on the agenda. And I also put benefits here. One of the other things we've discovered in the pandemic is that there's been a disproportionate impact on women workers because they've left the workforce under pressure because they feel as though they've got to look after children or sick elderly relatives or whatever it is. We've exposed a gaping gap in our provision of benefits, and that, I believe, is going to get filled. There is a lot of energy behind filling that gap. And that brings me to the point now. I think the government is going to get re-engaged in the workplace in quite a big way. There's going to be a lot of potential workplace legislation coming down the pike. Again, I'm predicating this on an election result, but I think there's going to be a lot of pressure post-pandemic for the government to play a much larger role in the workplace than it has in the recent past. A lot of these low-wage jobs have gone, but a lot of new wage jobs will reappear, but I think they're going to be spread around a little bit more. I think there's going to be a geographic dispersion of some of these jobs. Think in terms of Amazon warehouses or Walmart, Target warehouses. These are companies that are doing really, really well in this downturn. They are going to continue to do really, really well, and they are employing people in very large numbers at the same time. But the location of those jobs is not in the same location as some of the low-wage jobs that are being lost. And the final point here is one that I think is not being discussed enough. The labor market is going to be redefined. I think we're going to start seeing geographical spread in hiring that we're not used to. If you're a company or an employer in Connecticut, you're not reduced any longer to hiring people in and around or getting them to move to Connecticut. You can hire someone in Arizona. They can work from home. So your reach as a potential employer is now national. In some circumstances, it's probably international. Those people do not have to move. They can work for you. Your workforce can be scattered around the country. And I think that's going to change the wage rates and the competition for labor in some parts of the economy. And that's something that I don't think is getting discussed enough, but I think it's going to have an impact in the post-pandemic economy. So I just wanted to point out this two-tier recovery because it's been bugging me so much, and I apologize for that. So these two charts show you the change in employment. The left-hand one is the change by hourly wage ranges, and the right-hand one by educational level. The blue line is the lowest tranche of either of those. So the lowest earning or the least educated. The magenta line, the one that emerges at the top, is the highest paid or the best educated. And if you are in that magenta line, if you're one of the better paid or if you're one of the better educated people, this recession's over. You're doing quite well. You're back on your feet. You've learned to adapt. And that's where you start getting all this talk in the media about, oh, you know, the economy is improving, things are going well, so on. But if you're sitting at the bottom, that's not at all true. It's not at all true. And it's that bottom group that benefit the most from the stimulus from the government. And they're the ones where now that stimulus has run out, and I understand they're talking as we speak, right? And with that stimulus having run out, these are the people who have the most likely to spend whatever income they get, and B, are now sucking wind, to put it in a technical term. So that we are, I just wanted to point this out. Anyone talking about a rapid recovery has to look at that blue line and admit that it exists. Maybe get out of the bubble of the magenta line a little bit. All right. This, I think, is something we all ought to worry about. Long-term unemployment has kicked up. This is something that we do not want to see. We have managed to work it down significantly post the Great Recession, and long-term unemployment being 6 months. All right, looking for a job for 6 months, and we're starting to see a very disturbing uptick in it, and that's going to affect not just 2021, but potentially 22 and 23. Because don't forget, people who are out of the workforce for a long time, their skills tend to degrade. It's harder for them to re-engage. And the more of them you have out of the workforce, the slower the recovery is going to be. All right. Another grab bag that I think we all need to think about is the impact of this pandemic on the financial markets. And this is kind of hairy stuff. So I apologize in advance. The stock market beats the heck out of me, guys. It's gained 37% through. Is that a bubble or is it a big bubble? I mean, clearly post-pandemic, the stock market has got to, I would hope that it re-engages with the real economy to the extent that it ever has. As the famous saying goes, the stock market has predicted 9 of the last 5 recessions. And I think anybody looking at the stock market and trying to extrapolate what's going on in the economy is just completely missing the point. This is one of those times when I do wish they would stop the tickers on the television. Don't report about what the Dow or the Standard & Poor's did. It's got no consequence. 90% of this country doesn't own stocks directly. They have them potentially in a savings plan or a pension plan. They don't control them. They don't look at them. They don't even know they exist, half of them. The stock market is pretty much irrelevant for most people. But the bigger point is the next one, asset price inflation. We've had loose monetary policy for a very long time. And that is a great contributor to asset price inflation. We've all this money floating around in the economy hasn't gone into building new factories or buying computers or building something for the future. By and large, it's found its way into monetary or financial assets. And so we've had these asset price inflation, which has made it difficult for people to enter into, let's say, a new home or something like that. But it's also exposed us to a great danger post-pandemic. What happens when the monetary policy eases post-pandemic, if it ever does, let's hope it does. And what happens when interest rates rise? Because then post-pandemic, we're exposing ourselves to an asset price deflation. And I think that's a big, big risk. Nobody's talking much about it. because we're all obsessing over the current market. But if you look 2 or 3 years down the road, this has got to unwind, and there's a danger that it can unwind in a kind of precipitate manner, which in turn could precipitate a recession. I put inflation is non-existent. It's not quite non-existent, but it's negligible. Who cares? Natural rate. Every time I do one of these presentations, I like to throw something at you that will utterly confuse you, and you won't understand what it is, and I can feel proud of myself. The natural rate of interest is this presentation's version of that. The natural interest, I'm not going to get into any technical thing. The natural interest rate is the interest rate you should have if the economy is at potential and everything's humming along nicely. That's what the natural, in a nutshell, that's what it is. And but it's been declining for decades. That's why we've had such huge difficulty lifting interest rates in the last few years. Interest rates are so low, and they are so low because the economy operating at capacity requires interest rates to be 1-2% instead of what used to be 3-4%. We need to get back to that 3-4%, and I think that's something that this pandemic may well accomplish for us. We may get back, we may finally be able to get back to in a post-pandemic economy, to a natural rate of interest, which is more in that 3 to 4% range, so that the Fed has policy space at last when it hasn't had for 10 years. Why do I say that? Two things. One is we've had a glut of savings, excess savings. I've got a chart I'm going to show you in a minute. People are saving too much. Why are they saving too much? Which parenthetically means they're not spending enough, which means the economy is going more slowly. Why are they saving so much? The risks of employment in the economy, and now, of course, the pandemic have tripled or quadrupled that risk of job loss. So people are not spending the way they should. That's why a lot of the stimulus money, which flooded into the economy, was simply saved. It didn't have the stimulus effect that it might have had. But then there's this next point that I want to raise, and I haven't seen it talked about enough, and I think that we should talk about it. To the extent, as I mentioned earlier, that we have a chance to deal with inequality by raising wages and potentially raising taxes also. Inequality, by its very nature, concentrates spending power in a very few hands. That means, since those people who now have all the income and wealth don't spend it all, they tend to save it. We've created this excess of savings. Instead of people spending, we're saving. Inequality, if you lower inequality, you spread the money around, you reduce the glut of savings, you increase consumption. That raises the natural rate of interest. That's how you break out of this low interest rate environment. Something like 25 to 30% of the decline in the interest rates since 1980 are directly attributed to inequality. If you can reverse inequality, which I think we can do post-pandemic, you get back to much, and I put it in quote marks, much more normal economy. So it's a very important feature of the post-pandemic economy. That's obviously going to depend a lot on policy, but I think there's going to be a lot of pressure on wages as well. The last 2 points here are simply, I have to comment on it post-pandemic, because the budget deficit ought to raise interest rates. The textbook tells you that all this debt flooding into the market should depress the price. The excess supply should depress the price for the government debt, and that means interest rates go up. But it hasn't happened. Why hasn't it happened? Because monetary policy, the Fed has been buying debt like crazy to support the financial markets. So on the one hand, that we're flooding the market with debt, the Treasury's printing paper like crazy, and the Fed is gobbling it up like crazy to try to stabilize the markets. So we don't have a really good view into how the markets are going to deal with these deficits post-pandemic, because we've been neutralizing the whole thing. it's just that's why I say this thing is very difficult to talk about sometimes, because we just don't know. But in theory, if the theory is correct, which I would dispute sometimes in my wilder moments, if the budget deficit is as big as it is, interest rates should be rising. They're not. And so something is broken in the system. And right now it's monetary policy. But I could also argue that maybe the markets are just getting used to being flooded with debt, in which case all things change post-pandemic. Maybe we never have to worry about debt ratios again. And that's something that I think is going to be right on the agenda post-pandemic. Set all that aside, if none of these things happened with Japan post-pandemic, and we don't want to be Japan post-pandemic. There we go. Here's just two charts. I mentioned the household savings thing. You can see the enormous kick. That's the left-hand chart. Just in a quarter. This is the household savings as a percent of household income. And it's gone up. Part of that may simply be that household incomes have gone down. So, you have to remember there's two sides to this calculation, but there's clearly a propensity to save at the moment that we need to unwind. We need people to feel secure so they don't have to save. And then this, I wanted to put this chart on the other charts, which tracks the Fed funds rate is the green line, and then the 10-year treasury rate is the magenta line. This decline in interest rates has to be reversed because there's no policy space for the Fed anymore. Post-pandemic, that is a crucial thing we have to resolve. And I thought we show you this because all of those of you who worry about the debt, this is the federal debt held by the public. That's always an important caveat. This is the debt held by the public. The actual debt is much higher than this because the government holds its own debt. All right, so the Treasury issues debt, but then the Social Security Fund or whatever holds some of it. This is the debt held by the public. You can see the rise in the 80s with the Reagan budget deficits, the decline as Clinton, we finally got into a surplus, then the slight click, and then of course the panic, the recession driving it up, and it's really never gone down. And now in one quarter, we've jumped from something like 70% of GDP to just over 100% of GDP. And by the time this thing starts to unwind and we get to the post-pandemic economy, we're going to be looking at numbers more like 120, 130% of GDP here. This is the kind of number you expect to see at the end of a great war. And you're going to start seeing and hearing the debate talk about, oh, we've got to cut deficits, we got to cut back to reduce that. Well, I would remind you that this is a ratio. You don't just have to cut one, you could increase the other. So speeding up growth would actually reduce this ratio. So let's make sure we keep that as we move into the discussions post-pandemic. Let's keep that in eye. Guys, here we go. Inequality I've talked about, savings. These were things that are being disrupted and are clearly going to become long-term issues that we're going to deal with post-pandemic. The retail shakeout. Every day goes by, every week goes by, a famous retail chain goes belly up. But that was happening anyway. What's happened is it's been sped up and compressed into a very short amount of time. The post-pandemic economy, the retail industry is going to look very, very different, dominated by different players. Technology monopolies. We're going to have to deal with these guys at some point. Right now, they're ripping, they're generating incomes. Bezos has added goodness knows how many billions to his personal net worth this year. I mean, it's an astonishing shift. And that's one of the factors, as I mentioned, underlying the stock market valuations. Post-pandemic, this is going to be something, as I mentioned earlier, they're actually thinking of antitrust now. This is going to be an issue over the next 5 to 10 years in particular. Something I don't think people have focused on enough, the decline of middle-ranking business. And by that, I mean there's a squeeze going on because we've created an economy that is dominated by big players. And we've created an economy where it's actually tenuous or difficult to be a small player. The number of companies that survive become good middle-ranking companies, the kind names we probably don't flood off our tongues, but are incredibly important employers in the country. they have decreased. There's been a radical decrease in the number of middle-ranking companies quoted on the New York Stock Exchange because they're getting bought up. Post-pandemic, I think you're going to see a much more active Department of Justice, and I would like to think in terms of a more active antitrust component. I think that's a feature could come. Education, healthcare, what can I say? These are worth a presentation in themselves. We have discovered, those of us that never focused on it, that a lot of colleges generate substantial incomes from overcharging for resident halls of dormitories. They get huge incomes from that, or large incomes from that, sufficient to cover losses in other aspects of the business. And obviously in an economy or in an industry where people can't attend, and in an economy where actual education is likely to be done at a distance, we're going to see a shakeout or a change in the education, I put it industry. I know one or two of you hate it when I say the education industry, but it employs people, it provides a service, therefore it's an industry. Healthcare, I hesitate to go into that in too much detail. If there's one thing we've learned from the pandemic, which will be a feature of the post-pandemic economy, is that a healthcare system driven by private enterprise and the profit motive is really, really ill-equipped to deal with pandemics. And so the government, whether we like it or not, is going to be a permanent player on a larger scale in the healthcare industry. Last one I put down here, urbanization. I mentioned it earlier, people leaving cities. Urbanization, it has been a feature of the last 20 years. The United States is a city-based nation. Over half its population lives in large urban conurbations. That's been halted temporarily, but it's going to come back. I don't think that's a permanent change. That is, I think you'll see the shift to urbanization continue post-pandemic. The one thing that's going to be a problem post-pandemic, commercial real estate. Sell it if you've got it. It's going to be an issue. We're run by a commercial real estate developer. His portfolio must be looking pretty sick right now. And I think that's going to have ripple effects through the banking industry. I spent 4 of my years in banking unwinding bad real estate. And I think that real estate, commercial real estate, is looking at a bit of a bloodbath over the next 5 to 10 years. Post-pandemic, commercial real estate is going to look very different. Okay, wow, we're getting there, guys. What happens next? This is what I'm worried about. This is what I'm worried about. I showed you this chart before, and I cut it off before that second dip down. We are in the middle of that second dip, right? Without decisive policy, all of the people thinking that we're going to have a quick recovery just, blown in the wind here. You've got we've got to fill that gap. You can see this is a congressional, this is not me, this is this Congressional Budget Office projecting out. The economy is going to be operating below potential for a very long time, absent new policy and absent change in the post-pandemic economy. So with that in mind, this is what we're trying to avoid. What do we do? Go back? Simply restore what we had? I don't think so. I think there's too much now in the wind. There's too much action. There's too much being talked about that we're not going to go back to that. So what is it we're going to go forward to? And I've just cherry-picked some things that keep popping up in the conversation. Environment. The key here is since we now know that the government is going to be fairly heavily involved in the economy over the next 2-3 years to get us out of this mess, we ought to use that involvement to set the agenda, to force businesses to adapt. We're not going to give you free money, guys, and just hope you survive. We're going to give you money with strings attached. All right, so you don't have to accept the government money. Struggle on, good luck, guys. Go to the bank and get your money. But if you want the money from the government, how about dealing with your energy and your environmental footprint. I think you're going to start seeing this finding its way, not just as a Green New Deal, I put Green New Deal in it, but you're going to start finding the environment and environmental responses seeping into public policy as a more general phenomenon rather than a specific phenomenon. That may disappoint those of you who are sort of looking for a big splashy thing. But I think, in fact, that's much more likely to be successful if it gets spread out and becomes a part of general public policy. And I think post-pandemic, we're going to start to see that. The second one I mentioned several times, let me not repeat too much, but I think we're going to see a return to workplace regulation. I think you're going to see a chance of the minimum wage both raised and then potentially indexed, which would be a dramatic win for the economy because it would pump so much money into the economy, generate a lot of activity. And I think post-pandemic, that is definitely on the agenda. Infrastructure, oh my goodness, where do we begin? We need actual utilities that work. And I think you're going to see one of the reasons why the system as we have it is so dysfunctional is precisely because the profit motive doesn't generate a response that conforms with public policy. We want people to have good internet and bandwidth to work from home. And there is no real incentive at the moment for that to be provided because we've got a very, I won't say near monopoly, but we have local monopolies providing this. There's not enough competition. So either you get more competition or you have regulation. And I see that as a feature of post-pandemic. And I think, just to go back to my comment about environment, I think energy efficiency is going to be high on everyone's list in that. Then I think we're going to start seeing a return to government role in basic research. If you look at all these vaccines that are running, or you see the CEOs being interviewed about, oh, my vaccine's next week or the week after or next month or whatever. But the impetus and a lot of the money and the funding is coming from the taxpayer. So I think you're going to start seeing a return to government, a more aggressive government role in basic research. So the summary there is just this, I think one of the features of the post-pandemic economy is the rebalancing of the role of the state and the private sector. I'm hoping, guys, I'm hoping. All right. I do have to spend a couple of minutes on the recovery. It's fading, job losses continue. As I mentioned, all of this secondary wave of layoffs building, and next year's recovery going to depend entirely on the stimulus. Entirely, it won't happen very quickly if there is no stimulus. I just read there was a thing came across my computer just as I was starting that Mitch McConnell's repeated that there aren't the votes for any stimulus. So unfortunately, it looks like we're going to be waiting 3 months. So we're losing 3 months of recovery, which will embed some more poor performance. I want everyone to focus on, go to the bottom. The top part of the United States economy will see a V recession, maybe a V recovery, but the bulk of people in this country will not. And because they will not, that's going to bring down the overall performance of the economy. So the big question comes, how long will the economy underperform as we go into this post-pandemic world? And lastly, my summary of all of the above. Well, the first one is that the digital future has arrived at last. Well done. We've been talking about the digital economy for 30 years. And for various reasons, complacency, lack of innovation, lack of imagination, it never has really arrived. We've been living in a quasi-industrial world with digital stuff layered on it. But now we're really in it. We've got this work at home. We've got online retailing. I think education, healthcare, and financial services are going to be disrupted. The post-pandemic economy will truly be a digital economy. And I think that is probably the biggest takeaway from all of this. I think we're going to see, as I said, inequality. At last, we may be able to unwind a little bit of inequality. Better benefits. When I say better benefits, I would be shot by my wife if I didn't say not just better benefits, but portable benefits. Benefits that do not depend upon your employment contract. That is where the industry is going, and I think they're accelerating their efforts in trying to create packages where you get your benefit, and it doesn't matter what your employer gives you, you have benefits. We're going to see tax increases. I don't think the top layer of the economy is going to get away with no tax increases. Again, depends on the election. Please remember, and I'm going to be really controversial here, the purpose of a tax increase is not to create income for the government. It is to take money away from the wealthy so that they can't buy elections, politicians, and do all sorts of dangerous stuff with it. It's also to get it out of that asset cycle and channel it into the real economy. It's not to raise revenue for the government. If you hear politicians saying we're raising taxes so we can pay for this, shoot them. We don't need to raise taxes to pay for things, okay? I've mentioned the labor market changes, and I think we're going to see a much stronger safety net coming out of this. I think the next third point, I think, yes, there's going to be, all the talk is about how cities are, desolate, and there's tumbleweed blowing down them because all of the high rollers left. Yes, there's a significant change. The tax base of most of the big cities is going to take a big hit, but they will re-emerge because I think the long-term pressure for urbanization will resume post-pandemic. I tried to explain to you why I think interest rates are going to go higher. I hope I made that point. I'm not going to try to repeat it, but I think they're going to go higher. I think globalization will be reimagined. Supply chains will be altered. I think, as I mentioned a few minutes ago, I think the environmental concerns are going to drive infrastructure, focus on infrastructure. They're going to be, I think they're going to be melded together. When we talk about infrastructure, we will always, in the backs of our minds, have environmental issues right simultaneously. They may be hard to break apart, but focusing our environmental concerns and channeling it through a better and improved infrastructure, I think, is a way to kill two birds with one stone. And then it's the rebalancing the state and the private sector. And I couldn't help myself. I had to end with this, as you all know who said this. I think this pandemic has the chance to breaking once and for all the 40-year Reagan cycle. He said that. And in the pandemic, I'm from the government and I'm here to help, right? The four, was it the 9 most dangerous words in the English language, I think he said. When I typed it out, I said, I am, and I am. So I came up with more than 9. I had to go back and check to see what it said. And I realized he would never have said I am. The government's back in the game, guys. And it's back in the game in a fairly big way. And that's where a lot of our politics and controversy are going to be. But it's inescapable. Without a strong government, we would be in a major depression right now. And I think a lot of people are recognizing that and understanding it. And I think this pandemic is going to bring to an end that cycle and launch another one. And whether it includes all the stuff I've mentioned, I don't know. But it is now where it's accelerated the transition from where we were to where we're going to be. I think it's a digital future, an environmentally better future, and a less unequal future. So that's it, guys. Now, I hope I haven't bored you too much. So if you've got any questions, Gloria, you can channel them.
And do you want to take your slides down?
Yeah, I'll kill that. There you go.
Okay, great. Yeah. Thank you. So thank you, Peter. We do have some questions in the chat feature, so I'll read those. This is from Steve Sinding. Europe seems to be experiencing the beginning of a vicious second wave. If it arrives here with the same intensity, how would that affect your thinking about post-pandemic? Couldn't things get a lot worse before we see the rosy future you imagine? Yes.
Yes, the simple answer to that is yes. But the interesting part about that, Steve, is that I think it accelerates the transition that I've just tried to outline. I think that I think there's a high chance that we will see another downturn in or uptick in COVID and so on. I think that's going to precipitate another reaction. We've already, as I already mentioned, we've got a 3-month wait now, probably till we get any substantial government effect. So we're going to linger right through it. And I think those 3 months are going to be they're going to be the dangerous months. But it does lay the groundwork for an interesting post-pandemic, as I tried to give you some hints on.
Okay, Steve says good answer. He likes that.
Thanks, Steve.
This is from Bill Friedman. All of your policy options are progressive Democratic dreams, Republican nightmares. If successful, this would suggest a long-term decline of the Republican Party unless it undergoes a significant revolution or evolution.
Evolution. It's not going to. I think the answer to that is yes. I realize what I just said. I think that the point to be made here is that the policy options being presented the post-pandemic opportunity described through a Republican lens right now looks a lot like the pre-pandemic economy. It is. They're not talking about, apart from maybe there's some talk about antitrust with the technology companies, but there's not a focus on infrastructure constructively because they just don't want to spend everything. And you're already seeing them line up against spending masked behind this, we've got all this public debt thing. So they're going to build the fortress around their position built on that. So they have very little policy space. They're giving themselves very little policy space. I'd love to see some more conservative options, just so we can have a debate. But right now, I think the wind's behind the back on for the other team. I went looking, believe me, because I wanted to put them on that chart, and I couldn't find them. So yes, I think the Republican Party is going to have a discussion within itself. But who knows? Let's see what happens November 3rd. Let's see what happens November 3rd. If Trump wins or they retain the Senate, I think a lot of what I just said's off the table, obviously.
Okay, next question.
Go. Sorry, go.
Okay, next question's from Lee. Why do you think that globalization will suffer even though this is the knee-jerk approach? Oops, hang on a second. Even though this is a knee-jerk approach that our president would take. It seems our present situation is the product of a global pandemic. Why can we not minimize global segregation to make it easier for all of us to prosper?
Oh, wow. That's a little complicated. I think when I talk about globalization, I'm really talking about the policies of large corporations over the last 2 decades to spread their operations worldwide and to take advantage of worldwide opportunities. A classic example being, let's say, Apple, that manufactures and has a lot of its products assembled abroad and then shipped back here. Apple claims to employ 800,000 people, but when you look at it, they've only got 70,000 people employed in the United States. All the rest of them are sitting around the world somewhere. That's what I mean by globalization. And I think that to the extent we've seen how tenuous that is, I think you're going to see. I think you're going to see the supply chains and the organization of those logistics revised to make them stronger, so that if another pandemic occurs, goodness help us, these companies can get through it without the disruption that they've just experienced. So I think that that's the impetus. The other impetus to maybe a breakdown in globalization is trade wars. I mean, obviously, we're gonna if you start a trade war with someone, you're in essence disconnecting yourself in some way or threatening a disconnection. And I sense there's going to be a greater defensiveness at the national government level around the world, which will make globalization a very different thing. I don't think it's going to go away, but it's going to be a very different thing, and it's going to have different consequences. So I think it's on the corporate side, you're going to see it adjusted. And on the national government side, I think you're going to see, as I mentioned earlier, regionalization rather than globalization, I think is kind of a way to possibly to look at it.
Okay, next question. Your comfort with increased government involvement assumes that wise and adept people will be in government. That doesn't seem to be a valid assumption. So how do you change that?
Well, first of all, I would, I'm not sure it's a wise assumption. I mean, walk the hallowed halls of any large bureaucratic organization, and you'll find some really interesting people in the corners who could equally work at the Department of Motor Vehicles or something. So the idea that somehow government employees are a lower quality group, I'm not sure that I'm talking mainly about policy and the execution of policy, and and I think that you need an acceptance that government institutions can provide goods and services, do provide goods and services, and they're not just costs. And one of our problems in the economy, describing the economy to people, is people look at the government as a cost. Well, it actually provides a lot of goods and services to the economy, and it's not ever accounted for in the same way that you do in the private sector. So, for instance, the government doesn't have a balance sheet. So the fact that it has assets and nurtures those assets is never reflected. So I'm not sure how to answer that. I mean, do I have confidence? Do I have confidence in Apple doing the right thing? Do I have confidence in the Department of Labor doing the right thing? I would say I have equal confidence in those two things.
Okay, next question. On the subject of remote working, this had enormous consequences on the economy, but also it could also impact the American innovation. Building number 20 at MIT is the famous example of incubator space that sparks new ideas with chance discussions at the water cooler, etc. When we isolate ourselves by technology, are we harming this intangible asset? Collaboration through human interface, face-to-face. This will take a long time to understand. As an economist, how do you measure the long-term impact of this new phenomenon? It could take years to identify the effect.
Well, I mean, here's the interesting. I'm going to be kind of cute in my response. The people hanging around at the MIT water cooler are precisely the people that have to build the technology to get rid of the water cooler. And I think what you're going to see is rapid development of better, newer technology, so that social engagement is not eliminated by distance, and that social engagement can be reintroduced. And I think there's a lot of people working on that, because it's obviously the holy grail for a lot of these people. So the irony is that the people who praise the collaboration, let's all get in the room together and bang out a solution, they're the people that are going to have to provide the solution to their own problem. Now, I'll give you a very close personal anecdotal. It's nothing to do with me. It's to do with my wife. She was running one of these, what they call agile development teams, and it started in March. The principle behind agile development is just what the questioner suggested. You get everybody in a room from different parts of the company. They stuff stuff on whiteboards. They solve problems, and they generate a lot of creative activity. Well, they couldn't do that. My wife's team couldn't do that. She had more than one team, but she couldn't do that. But they still delivered on time and under budget, and they found various ways to do it online. They had whiteboards that they could all write on. They instituted all sorts of offline chatting that they got into. She established all this line of communications, and they discovered that they were developing stuff just as rapidly as they had expected to. So I think it's got a lot to do with the way you go about it. In principle, it sounds like we're losing this coffee, the water cooler, the coffee machine discussion. But we're actually not, if you know how to use the technology and get used to using it. So I think, whilst, yes, there's a potential issue with innovation, and you mentioned the MIT lab, at the same time, I think you can get around it, and I think you're going to see technology deal with that. Already, there was one person giving a presentation on the future of work, and the technology allowed you to have an avatar walking around the room. And you could control that person and who that person bumped into. So that technology is almost there. You will be controlling your own persona remotely, having a conversation. It's kind of weird stuff, but I think it's going to be there and gets to the heart of the problem you just mentioned, which is a good that's a good question, but I think we'll get around it.
Right. This is from Jeff Sands. First of all, he says, Peter, great job. But Jeff says he worked in the world of corporate distress, and his question is, where is the distress? Not in the bank loan portfolios, they're better than a year ago, not in commercial and industrial sectors, not in private equity valuations have retained pre-COVID highs, not in auction values, same, not even in Boeing's supply chain. He talked to them today. A few weeks ago, JP Morgan head economist said damage so far from COVID is 1 billion, but government threw 4 billion at it, and Congress is struggling to throw another 2 billion at this
trillion.
Oh, trillion? Whoop.
It should be trillion, yeah.
Okay. I think he says, I think we've solved 90% of the problems with debt.
With debt, correct?
Yes.
Okay, yeah. Well, Jeff, problems in bank portfolios lag, don't lead. And you're going to say, as one of the reasons we hadn't had a lot of the issues that we could potentially have had is simply that there was so much money slushing around that people were able to continue paying their bills. And so you weren't seeing the stress build the way that you might have seen it build without that money slushing around. Absent that money, you would have seen some of these things building up, okay? And we're going to learn this the hard way over the next 3 months. I would imagine there's a lot of people running around also, just as an aside, I think there's a lot of people running around in the real estate departments of banks, taking a good hard look at their commercial loan portfolios and wondering just how much value there is in them. I think that the credit card companies, the student loan lenders, there's a lot of people will be looking around. Right now, they're all, holding hands and hoping nothing happens. But I think as you go into 2021, absent more stimulus, I think you're going to see, you will see this stress building. I think we have to be really careful to think we're past the problem, because I don't think we are past the problem. It comes back to what Steve said earlier. If you have another round of COVID, another spike in the problem, you're going to start seeing some of these layoffs that I mentioned, long-term unemployment building. You've got people unable to pay their bills. We've got food lines growing. It could get ugly. It could get ugly. But I agree, by some measures, it's not that you could miss all of this. Yeah, I think there's a big difference between what goes on the surface and what's going on underneath at the moment. Sorry, I don't think. Yeah.
Okay. Bill Friedman, working at home on a mass scale means less close human interaction,
Yep.
distancing, and depersonalization of others in our cities, societies, and nation. This, in turn, almost certainly means less sense of unity, less identification with others, less concern about them. This will exacerbate the effects of social media fragmenting the society. Putnam's bowling alone will become bowling at home. This is a likely important sociological consequence of working at home. Another point, working at home will put pressure on marriages and families, somewhat like what is happening under closure and lockdown, though milder. It may not be healthy for couples to spend 24/7 with each other. This too is a sociological issue, perhaps a criminal one.
Criminal one. I like that. It's a good twist. Good twist. Then 40% of the people, 40% of the people who surveyed said they want this to continue. I'm not saying work at home is going to be there for everybody 100% through the economy. What you're going to see is it as an option for a lot of people. I think some companies where they're highly technically immersed already, that it's an easy transition for them. And I think that there are going to socialize. It's going to be a sociologist's dream for the next decade. But looking at it from a cost-driven basis, corporations have driven down that shareholder. They've squeezed shareholder value out wherever they can. This is a place to squeeze shareholder value. If I don't have to have a big expensive office to house you, and I can make you stay home and do your job, I'm going to go down that line. And so that's point one. Because that's like a ball rolling downhill, so to speak. The other part about it is a lot, as I mentioned a couple of minutes ago, but with reference to the MIT thing, I think people are getting used to this. I think we're early days in this process. People are already adapting. The technologies are going to change. I think you're going to start seeing the way in which we think of housing. Houses in the old days used to have libraries. Expensive homes had libraries. Well, houses are going to have to start having rooms where you can work from home. And I think that that's a long-term change that's going to set in. It's not going to happen in a year or 2 years. It's going to happen over a decade or 2 decades. But I think this is inevitable. This is I come back to the Francis Cancross book. If anyone can dig it out, please do. It's a great book. The Death of Distance. It's a great book. And it was written in 1993, way ahead of her time. A wonderful piece to read. But yes, you keep hearing people saying all these issues, sociology this, sociology that, but the bold economics of it at some point will force corporations more and more down this route.
Okay, that looks like it's the last question. So thank you, Peter. Excellent talk. And thank you everyone for joining us here. I hope to see you at the next lectures, and have a good evening.